Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial, and today, wow, for once, I don't have a ton to say about market news because market news today, in my opinion, wasn't terribly interesting. I just have a few things that I want to point out today, but then I want to get into talking about what I think is going to be one of the better investments over the next decade or so, and I want to talk to you about why that is, how actions of the Fed are going to affect that. But first, let's get into a few signs here. I know that China reported that they had a robust and growing economy by our standards, maybe not by theirs last month. That really doesn't seem to be the case, though, when we start looking at the data that's being put out. So China's economy is showing signs of weakness in October. China reported weak data as the world's second largest economy struggled with COVID lockdowns and an international slowdown. So they released, it was the National Bureau of Statistics released a bunch of studies on Monday, and it showed a contraction in services, manufacturing, and construction. The figures are an ominous sign for the global economy as the Federal Reserve and other central banks spent much of the year raising interest rates to bring down inflation. China is both a big driver of demand as well as the home for important factories for companies such as Tesla and Apple. So we've talked about on this channel numerous times, and I got a nice sort of thank you email from someone about warning them about the dangers of political risk when it comes to China, meaning the rug can just be kind of pulled out from underneath you at any time. There's, political power is more important than economic power in the world of Chinese politics and the world of Chinese geopolitics. So it's very difficult to predict how capital markets are going to react and how stock markets are going to react and that sort of thing. And periodically, you do get the rug pulled out from underneath you. This happened in like 2012, 2013 in smaller companies in China. It's happening again right now across the board. And with the Chips and Science Act and the recent sanctions placed on China in terms of exporting, high-end computer chips to China, I don't think that the people that I'm talking to in the world of investing right now really realize what that means for China. Something like 93% of all of the advanced, or actually 92% of the advanced chips that China uses for AI and things like that, those actually come from Taiwan. And as of this moment, Taiwan has basically stopped selling chips to China that are in that category. Now, I don't know exactly how that's going to shake out because one of the reasons they halted sales was really just a preemptive way to avoid violating any U.S. sanctions. And when they get more clarity on that, they may resume selling those chips to China. But this definitely pulls Taiwan even more into our economic sphere than it was before. They're even more reliant on our protection as a geopolitical force than before. And it's kind of an indication that now more than ever, our economic worlds are starting to bifurcate. Now, I don't know if that's a good sign or a bad sign. History is going to show that decades from now. I'm not going to be able to predict that in the future. And, there are a lot of things going on with China where, we see rising income. Chinese wages have increased by something like 15 times over the last 30 years or so. No country in the history of the planet has seen wages rise that quickly. Part of that has to do with a labor shortage in China. I know that sounds weird with a country that has over a billion people living there. I think is at 1.4 billion. But by the end of 2100, the UN is predicting that the Chinese, as a nation, is going to have the largest contraction in population in history as well. That didn't involve massive wars, but by the end of 2100, there may be as few as 500 million people in China. So how that is going to be managed effectively, maintaining their economic power and might, is something that we've never really seen before. We've never seen a nation or a civilization really go through that sort of population decline just from low birth rate and be able to maintain their society. Something would definitely have to change. So, yeah. Let me address the first question here, and Mark kind of addressed that for you. But I thought I would jump in early with my question from the UK. I may be silly, but if the Fed pivoted, what does that actually mean? Pivoted means they go from raising rates to decreasing rates. I mean, that's a hard pivot. I think what people are really hoping for in a best case scenario is we get one more 75 basis point rise, and then the Fed indicates that the interest rate increases are going to be a bit slower going forward. So I predicted a 4 to 4.5% Fed rate by the end of the year. When I predicted that, I was told that I was a moron. We're already there, folks. It looks like we're going to be pretty close to 5% by the end of the year. We may be right at 5% by the end of the year. But their decision is going to be data driven. It's not really, and there are a lot of signs right now that actually point to the Fed continuing to raise interest rates. So the GDP numbers going up in the last quarter, 2.6%. Of course, those will be revised upwards or downwards in a couple of weeks here, but that is not necessarily the sign that the Fed wants to see when their primary concern right now is actually controlling inflation. The economy is still creating jobs, and it's still creating jobs at a really good clip. Businesses businesses across the board are still struggling with labor issues right now. They're not struggling with demand. And I've talked to a number of other people in the same industry that I'm in, and I'm in several different industries and across a number of different professions that are all saying the same thing. It's difficult to find workers because right now you can't offer them enough money to pull them away from the job that they have. Now, I constantly hear this refrain that nobody wants to work, but that just simply isn't true with an unemployment rate of 3.6%. That's basically full employment. There's always going to be a small section of the population that doesn't want to work, will find any way to get out of it. And basically, and the issue is if you can't find employees, it's because you're not paying them enough, or you're not providing the opportunity to earn enough. I'm watching people go to a 6-month coding camp and walk out of a 6-month coding camp earning $80,000 to $100,000 a year, and that's happening all over the country. And when I say coding camp, they're really learning how to do like automation services for large companies and things like that. And just a few weeks ago, these people were waiting, or a few months ago, these people were waiting tables at a restaurant, or they were dealers at a casino or something like that. And now they've significantly increased their earnings. Well, maybe not in the case of the casino dealer, but he significantly increased the way society views the way he earns money, right? He's not likely to go back to the other position, even if the pay was equal, because he's simply going to be getting more respect now for what he does. And that's a huge part of the cultural shift that has happened over the last 20 years with the fight over minimum wage, who deserves a living wage and who doesn't. Jobs that have been deemed not deserving of a living wage, those are the people that are having a hard time filling positions, a really hard time filling positions. And at the other level, the other end of that spectrum, the debate is really on salary and pay. How much can the company really afford to attract talent? Because everyone wants talent right now. So until that calculus kind of changes, by that calculus, I mean, until we see the economy stop creating jobs and until we see unemployment rates a little bit higher, I don't see the Fed really backing away from interest rates. They may slow down how fast interest rates are rising, but I don't see them backing away from that. So I made a prediction on October 13th of one of my live streams where I talked about this being the bottom of the market. So far, that has been proven correct. I'm not saying it's going to be proven correct indefinitely here, but look, we are coming off of one of the best months in a very, very long time. The Dow slipped today, but still has a best month since 1976, and it was one of the better weeks in a long time too last week. And I heard the number since 1915, but that article got taken down probably because the Dow slipped a little bit today. But if the market was only up like 0.2% today rather than being down, it literally would have been the best day or best month since 1915. So, yeah. And actually, yeah, it's a good point. Drivers and low wage paying jobs are not getting employees, and that's really the that's really the calculation. Even like drivers, people that are in trucking, they're actually making really good wages now compared to what they were making just a couple of weeks ago. So, Catalan Divine says, I have an opinion. We go up by the middle of November and we'll start the real crash. I'm not sure we really get lower than about 3,600, Catalan. I think that just based on a calculation of what fair market value was at the top of the economic cycle, I think it was right at about 3,600. And I think that we kind of retraced overvaluation of where the economy was. Now we may go back below that 3,600, but that's going to be based on like new information, meaning something happening on the economic scale, on the economic side that we can't predict, or something happening on the geopolitical side that we can't predict. I think that's the only thing that is going to drive the S&P 500 below 3,600, meaning that if Russia were to find a way to impact global oil supplies, or if there was another sort of near bond collapse like we had, our collapse in the bond market we had in 2008, and even 2018, you folks may not be aware of that, but the bond market almost collapsed in 2018 and was backstopped by the Fed. But I think that's the end of it. I think that right now, we fully expect there to be a recession. I do. I fully expect there to be a recession, even though we aren't in a recession now. If we've had positive growth over the last quarter, we had, we may be looking at a double dip recession right now. And I think that's entirely possible. And we are definitely in what is called an earnings recession right now. Earnings are being complicated by inflation and, of course, by the strong dollar, which on the surface of things should be a contradictory statement that inflation is a problem and the strong dollar is a problem. How could the problem be the strong dollar if we have inflation? Well, the answer is because inflation is worldwide. It's not localized to the United States, or at least limited to the United States and our largest trading partners. It is almost everywhere. It is almost ubiquitous on the entire planet right now. So that's the reason we're looking at, one of the big reasons we're looking at earnings recession. So there's a couple of companies out coming with earnings coming out tomorrow, and I'm really thinking about SoFi here, where I think that the bottom line numbers for SoFi are probably going to look pretty good. What concerns me is the rate at which they're acquiring new customers, the amount of revenue that they're generating per customer, and if that's going to keep up with the projections they had in terms of growth. I mean, that's my real concern. So I think that on the surface, we're going to be looking at another SoFi earnings that is, much better than we expected. But I'm looking a little deeper here, and I'm looking at in terms of user growth, and I'm looking at terms of growth of their other platforms, because we're going to see a flatlining of their loan business for a little while, meaning it's not going away completely, but it's going to be in trouble for quite some time. So I want to see financial services and the technology arm really kind of pick up the slack there, and it has definitely started to do that. But I think with the general economy starting to show shaky foundations here, I think that the chances of an earnings miss are probably pretty slim, but I think the chances that the results for SoFi underwhelm are getting a little bit larger. And I was actually blown away by last quarter's revenue, but probably revenue, their guidance, everything. I was blown away by it, but probably because my expectations were so low. Okay. So my expectations are not quite as low going into this earnings. So, outperformance to me is not really that important, but meeting expectations, which are not entirely arbitrarily generated by analysts, but meeting expectations is pretty important to, I think, to the investment. And there's a lot of different companies that are their earnings are coming out, and it's been a mixed bag in terms of earnings, man. It really has been, where everything has basically just been not as terrible as we thought, but there are some good underlying signs, particularly when it comes to financials. Okay, so one of the other things that we want to talk about is this today, which is the Fed killing the housing market. So, what does a Fed killing the housing market mean, especially in a high inflationary environment? So, the economy grew by 2.6%. The average rate on the mortgage passed 7% last week. So sales of newly constructed homes dropped by 10.9% in December. That's down 17.6% from a year ago. And that's pretty big. Home refinancing has dropped by almost 90% over the last year or so. And mortgage applications are down something like 32%, right? Let's remember, though, that residential investment counts for just 4% of the U.S. economy, but it's 4% of the U.S. economy that most people that have money are invested in, if you understand my meaning. Almost something like 62% of Americans own their own home one way or another. when we see a pullback in the market, when the market is not as hot, when people don't feel like they could dispose of that home at any time and make a bunch of money off of it, we do see a bit of a tightening when it comes to consumer spending. And economists love to say that housing is the business cycle. The health of the housing sector is very closely tied to the cost of borrowing. So it makes sense that Fed policy would weigh on home prices and sales earlier than other sectors. It's definitely weighing on sales right now. The problem that a lot of people don't remember right now is that interest rates are going to weigh on sales right now, but the breakdown in prices is going to come a little bit later. The difference between now and 2008 and now in 2000, and like 1998 to whatever it was, we had the last housing crash before that. The difference is they weren't in a high inflationary environment then. So I do expect to see a modest decline in the price of homes just based on the fact that interest rates have gone up so fast. Over the long term, though, I think that any decline in housing prices is probably going to be more of a blip depending on the market you're in. I think in certain like super overpriced markets, like say Phoenix, Arizona, or certain places in California, Austin, Texas, and a few other areas, I think that the price decline may be pretty significant. In the realm of 10 or 15%. I don't expect it to last for a very long time, though. But we are actually looking at, I think, the first market pullback since 2012 in housing. But in an inflationary environment, I expect that to be muted because housing prices are still going to go up because of inflation. So what does this mean for an investor? What does this mean for someone who's looking at a way to navigate a high inflationary environment, who is not really willing to make that pivot into value investing, which in an inflationary environment, value investing a lot of times into stocks that pay dividends that do represent a good value, meaning you're buying $1 worth of value at like 80 cents or something like that. You're buying that on sale. But a lot of investors aren't really able to recognize what value investing really is because it hasn't been very popular for 25 years or so. The other option is taking a look at rental real estate. And I'm not necessarily talking about going out and buying your own rental real estate. What I'm talking about is REITs. This is interesting here. Home prices are falling faster now than during the 2006 bubble when it was bursting. And the CEO just revealed why. And it goes back to a lot of your investors bailing out. I had an interesting conversation with my fishing buddy yesterday, who's a kind of a big time real estate investor. And he's talking to me about the fact that almost is somewhere between 70 and 80% of single family homes have a mortgage right now at an interest rate below 4%. Unless you're forced to, you're pretty much not going anywhere in that house. You borrowed that money for just about as cheaply as you're ever going to get it. I never expect to see mortgage rates under 3% again. I don't expect to see them possibly under 4% for as long as I may live. And that's just based on the fact that the last 10 years or so in mortgages was just anomalous. It's never been that low, and it's likely never to be as low again, particularly when you look at some of the massive shifts that are going on in our economy. The fact that we could have elevated inflation for a generation here. I'm not talking about the 10% range, but typically we have inflation around the 2.3% range on average. I could see that being closer to 4% for an entire generation, largely because of the amount of public investment that we're going to see in reshoring or attempting to reshore some high-end manufacturing. I'm really thinking about semiconductors, automobiles, and a bunch of other things. So I see that happening in the future, which is going to require, and also with renewable energy, I think that as the era of energy derived from fossil fuels is starting to come to a close, the United States probably doesn't want to make the mistake of repeating the strategies, supply lines, and the energy strategies we had before that led to more than a century of warfare, led to more than a century of conflict, a lot of it being not extremely profitable for the United States. And look, when I have these discussions with you guys realize I'm not generally talking about right or wrong here. When it comes to geopolitics and the economy, it's all about power and money. Morality is a very small part of the calculation there. But when we take a look at this, that I think the investment in green energy is actually going to keep us on an inflationary cycle moderately higher than it's been in the past. Like I said, it's averaged 2.34% over the last 30 years. It's going to be higher than that over the next 30 years, possibly as high as 4%. I know that sounds really low now, but when you're doing calculations in financial plans like I do, running 2.34% inflation or 4% inflation is a massive difference in what you can expect your future dollars to be worth. So it is actually a huge difference when compounded over that 30-year period. Although in the moment, it doesn't sound like very much, though I understand that. One of the things that I would be looking at right now to help me have a chance for capital appreciation, to help me keep up with inflation, is certainly residential REITs rather than individual rental properties. Individual rental properties, of course, come with the responsibility of managing that individual rental property. And it also inherently comes with a lack of diversification if you don't have millions and millions of dollars to spend. Something like this company, which is Mid-America Apartment Communities. Remember, real estate investment trusts, they're not like regular companies, right? They are required to distribute most of their income after expenses back to the investor, or there are tax penalties to do so. So some of the traditional measures that we look at, like price to earnings ratio at 29, that actually really shouldn't be considered. Earnings per share should, but price to earnings ratio really shouldn't be considered. The price of the stock, in many cases, if all else being equal, the price of the stock is really going to be determined by the consistency of earnings and the dividend yield when it comes to a real estate investment trust, or the distribution yield when it comes to a real estate investment trust, less so than earnings per share or price to earnings. Okay, we're looking at stability of earnings. So in the case of, let's say, Mid-America Apartments, when I'm looking at returns since 1994, particularly since July 1st of 2008 here, we're looking at average returns over that time period of about 15% per year, right? With roughly a third of that, and that's including dividends and capital appreciation, with roughly a third of that coming from dividends over the lifetime of that investment. That is something that is going to be more and more attractive to people going forward. And let's talk about why that is. A couple of weeks ago, I had one of my buddies, Marsha, on, and he was talking about inflation numbers and how they're calculated. And he mentioned something that I'd just kind of forgotten about, is that 35% of the calculation that the Fed loves the most when it comes to core inflation, 35% of that is rent, right? So until rent starts to slow down, it's going to be very difficult for everything else rental increases start to slow down. It's going to be very difficult for those numbers to decline back to where they were before, which is inflation at 2%. I don't see this happening anytime soon, largely because the Federal Reserve doesn't have any levers on rent. They have levers on the price of housing by raising the cost of borrowing. So if you could get a mortgage for 2.65% at the beginning of the year in January of 2022, and today you can get a mortgage for 7%, you have more than doubled the amount of interest you would pay on that loan. And if you're trying to buy a $400,000 or $500,000 house, it's basically reduced your buying power by about $150,000. Okay, meaning if you could afford a $500,000 house in January, today, if you can only make that same payment, or you can maybe even make less because all your other expenses have gone up, now you can afford to buy a $350,000 house. So that is eventually going to start capping to a degree, and you have to figure in inflation here, that's going to cap housing prices on the way up. But how does that put any pressure on rental prices? It actually doesn't. It's going to allow, without an expansion of the supply of rental units, it is actually, and especially with a lot of these single family homes that investors bought in 2019, 2020, I'm talking about these large investment firms. Hopefully we're going to see some of those come on the market as rentals. But what it looks like right now is a lot of these investors are bailing out and trying to sell their homes right now, which means that they could possibly, people could be moving into those homes. But I'm hoping they end up becoming rentals. In that way, it kind of slows down the pace of how much rents are rising. But what I expect to see here when it comes to real estate investment trusts like Mid-America Apartments, and let's look at a few others here. We're looking at Equity Residential is one of the ones that I'm invested in another account. Avalon Bay Communities, which is kind of like luxury apartments. I also own Res, which is a REIT of REITs, and it focuses just on residential and like storage REITs. Uh, we're looking at a really long period of time where residential REITs would seem to have a tailwind and things are going to be working in their favor, where there is almost zero pressure because we don't have rental real estate inventories expanding quickly enough. There's almost zero pressure to lower rent prices. And we're also seeing 40% of the people who could have bought a house in January have pretty much now been priced out of the market. And they're forced to either stay in the place where they're renting, or if they even if they decide to move, or leases are renewed, and leases renew every 1 year, guys, those rents are going to rise every single year because the market can bear it, because those people don't have anywhere to go. They can move back home with mom and dad if they're young enough, but for the most part, people are just going to be stuck eating a higher rent check. Inflation is going to be bearing down on them. The lack of rental inventory is going to be bearing down on them. And this bodes well for companies like Mid-America Apartment Communities, Essex Property Trust, Avalon Bay, Equity Residential, but looking at residential real estate investment trusts. I'm not looking a lot of commercial stuff. Well, the other thing you need to pay attention to when you're looking at residential REITs is to look at how much they hold in actual property versus how much they hold in mortgages. A lot of these residential real estate investment trusts hold a significant, like 30 or 40% of their holdings in actual mortgage-backed securities or something like that. And they're able to get away with it because of how the rules work. But I don't like that. Those are the ones that got in big trouble in 2008. Something like EQR is really set up well, or Avalon Bay Apartments is really set up well. Mid-America Apartment Communities as well. The other thing with Mid-America Apartment Communities as well is kind of the lack of volatility here. Although it's been pretty volatile this year, going from 229 down to 157, with a yield at 319, and the fact that they've increased dividends in almost every year. There's been not a huge amount of pressure to increase dividends to sort of keep up with fixed income investments. We are going to see a little bit more of that pressure going forward from shareholders who have Mid-America Apartment Communities saying, hey, new investors can get 4% in a 2-year treasury. Why would they buy Mid-America Apartments if it's only yielding 3.19%? So some of that concern is going to be on the table as well. And I would expect them to see not just Mid-America Apartments, but every single residential real estate investment trust out there really starting to do a better job of cutting expenses in order to drive up their distribution yield. So, yeah, take a look at Mid-America Apartments and all of their competitors and folks that are sort of still in that field. We're looking at, there are a number of companies out there that there's actually only one company in the sort of retail space in terms of real estate investment trusts that I would even consider right now, and that's this one right here. And that's going to be Realty Income Corporation. And the only reason why, crude oil at 86, exactly where the Russians would like it to be. So the only other one that I would invest in that is not a real estate investment trust that primarily concentrates on residential real estate is this one, which is Realty Income. They are a retail residential retail and investment trust, meaning they invest mostly in retail properties. But we're not talking about shopping centers or something like that. We're talking about single tenant properties like Home Depots, Lowe's, Albertsons, or Kroger, or if you're in the Houston area, I wonder if Randall's is still around. But you're looking at those really large tenants like that are stable, that are going to be around forever. I think the average lease of their portfolio was something like 19 years or something like that. And even during the pandemic, they had something like 96% of their renters were paying their entire rent. So this is one of those companies right now that I think is a little unfairly beaten up. They have not, their earnings has looked very good in terms of stability. Their distribution yield is at 4.78%. And I think that they're a little unfairly beaten up at this point. Now, I'm actually not buying any more of this right now, just because I've owned this company for years and years and years, and they're local. I think originally they were located in Escondido, California. I don't know if they still are, but I got involved with them years ago because they were a local company, and they've expanded nationwide here. They got a market cap of $38 billion. And if you have never invested in a REIT, you probably never heard of Realty Income Corporation, trades under the symbol O. But if you have traded REITs before, then you know who Realty Income Corporation is. Now, this is one of the only companies out there that owns any retail real estate that I would purchase at all. What I would avoid like the plague is any real estate investment trusts that deals in offices. I would absolutely. I mean, they're trying to give away space right now, and I would absolutely avoid them like the plague. And this is one of the things that came up in conversation with my friend on our fishing trip yesterday, where he's saying that no one wants to have the conversation, but they're all starting to notice that commercial real estate, office buildings, are starting to look absolutely terrible. There's nobody there. Usage is really low. And he spouted some actual figures about how much a workstation gets used now compared to how much it was used prior to the pandemic. And I don't remember the actual numbers, so I'm not going to quote them to you, but it was stark. The difference was stark in the range of a 30 to 40% difference in usage of offices pre-pandemic and post-pandemic. And I think that it's not that offices are going away. I just think it's going to take time for the market to figure out how offices are going to work in the future. It's obvious that there are many, many people never returning to that 9 to 5 job, sitting in a cubicle, or many people that don't dream of a corner office anymore. That is not the American dream anymore. That corner office, the white picket fence, and the 2.1 kids. That is not everyone's American dream right now. So anyway, I'm open to questions, guys. I've done a lot of talking about what I think is going to be one of the better investments going forward. And actually, I started talking about this a while ago, that residential real estate looks like it's going to be a very good investment. But I want to be as widely diversified as possible. This is one of the larger holdings that I have in my individual portfolio. And I got to be honest with you, though, I'm not incredibly happy with performance of this. It's a REIT of REITs, so it's actually an ETF. I'm not incredibly happy with the performance of this over the last couple of years the problem is because it's how it's weighted, right? I'm not pleased with how it's weighted and the fact that the expense ratio is pretty high, but I do like the fact that I'm very heavily diversified. So all the other companies that I mentioned before pretty much are actually held a little bit in this fund. So year to date, it's down 27.48%. Yield is about 3.6%. When I'm looking at returns over the long period of time since 2007, we've seen a pretty healthy return from 1755 all the way up to 7141, and that's right about. I think I ended up buying it somewhere around this time frame, probably 2009 time frame. I've done fairly well in this investment, but I really bought it for what I thought would be increasing dividend yield, and the dividend yield has increased. It hasn't increased with the pace that I thought it would, largely because they took a huge hit in the long-term care properties that they owned. A couple of them really have not performed to how they were expected to perform. But I do think that business as well is turning around, largely because it's this year. This year, half of baby boomers have now retired, right? And the other half are soon on the way. And if they've retired, it means they're 67 years old. Long-term care for baby boomers is not far behind. With your oldest baby boomers now in their mid 70s, long-term care is not far behind. And a lot of these real estate investment trust companies are heavily invested in long-term care facilities. I see that business is going to grow in the future. So Sheila Show says, what is the American dream now? Sitting on a beach in Cancun with a laptop working remotely. You know what? I'm sure that's the American dream for a lot of people. And if you watch your YouTube algorithm is, of course, influenced by what you watch. And I will say that a lot of those expats working remotely on a beach in Cancun or wherever they are do come up in my feed. So maybe that's my American dream right now. The problem is I already live in a place where I could go work on a laptop at the beach every day. It happens to be, the second largest city in all of California, but our beaches are pretty nice and our internet access at the beach is pretty good. So my problem is I make myself work too much or worry too much. There's a lot of days that I spend behind my computer just researching things in my house, which is very nice. I enjoy my home, but I could do the same thing at the beach with a drink in hand and just do my research there. In fact, Sheila's Joe, you have inspired me. That's what I'm going to be doing. I'm going to be spending at least one day a week now working at the beach just because I can. I hope you're jealous. What's the weather like where you are now? Anyway, yeah, so I did want to make one quick comment too. I told you guys that I don't really talk about democracies, foreign democracies, unless it affects the economy. But I did want to take 1 second to address what's going on with the Brazil situation right now. It looks like Lula da Silva has defeated Jair Bolsonaro in the election. And if you look, that Petrobras stock declined pretty precipitously over that. And that's largely because Lula da Silva indicated that he would keep Petrobras a state-owned company and he wouldn't let them go private. So the reason that the market in general is up in Brazil, it's probably because it's not going to be as bad as Americans fear, right? And let me talk about that. When Lula da Silva was first elected president, I was one of these people that thought it was going to be a disaster for the Brazilian economy. I thought that he was so far left that he was going to make a lot of decisions that on the surface would seem very well, but just wouldn't work very well in practice. Well, that turned out not to be true. He's very much a trade union leftist, but also very pragmatic. And his policies were far more business friendly than anyone expected. And the Brazilian economy did fairly well. Now, I'm not going to say anything about the legal cases that were against him or his prison time. I don't have any opinion on that because I didn't follow the case. And number one, I don't know what went on, but I will say that the reaction in the business community in the United States when he was elected the first time was extremely negative. The reaction in the stock market in Brazil the first time he was elected was extremely negative, but he proved to be very business friendly. Yes, he did regulate the environment a bit more to protect the rainforest and to protect indigenous rights, but also he was very business friendly, particularly when it came to the oil business, which kind of surprised me. So that's the only comment that I'm going to make on that election. That is the reason why the market is not reacting the way a lot of people predicted, is because they've forgotten that he was president before and he was pretty business friendly. So when it comes to the American dream, says Mark Butler, says, I think that's the YouTube hype. People just want somewhere affordable to live. Lots of jobs are concentrated where that's not possible. That is true. That is true. There are a lot of great jobs that you could have in another city that you couldn't have and live a great life where you or I live, Mark. That is absolutely true. You have to do something else. And, I've been to places where property is dirt cheap, and what we see there is a dearth of really good jobs as well. And that's kind of the conundrum there. Hi, Jason. In Australia, industrial property is going great. Residential is slowly dropping off, but in patches and new generation of low energy consuming office buildings in big demand. Interesting. So, yeah, I don't know what to say about the Australian industrial property market. I would have no opinion that is valid. And here in my mind, there's a separation between industrial properties, retail space, and like office properties, right? So office properties, I'm talking like the tall building that houses a bunch of financial and insurance companies and like lawyers and things like that. Those places are hurting right now. But I'm looking to move another business that I own. Actually, two of my other businesses. One I'm looking to expand. The other I'm looking to move into another space. And I can't find retail space to do that. It's just not available. And I'm actually surprised that prices aren't higher for retail space because of the lack of space available. But in terms of office space, if I wanted to go somewhere in San Diego right now and get an office space, I would negotiate pretty hard because I know they're hurting in that respect. So He says office occupancy is back to 75% as well as compared to pre-COVID. Yeah, that's actually terrible, Hal, that office occupancy is back to 75%. And when it comes to occupancy, I assume that you mean the offices that are rented out. If you are a building manager and you have less than 95% occupancy for, let's say, 2 quarters in a row, you're going to get fired. You are absolutely going to get fired. The same is true of an apartment building too. If you have less than 95%, if you have more than 300 units and you have less than 95% occupancy, you are going to get fired if it stays that way for 2 quarters. So 75% is actually a pretty horrible indicator. Now, if you're talking about 75% usage of offices, meaning they're rented out, but it's only being used 75% as much, that I could believe. And that what I would say is maybe not as terrible as a sign. But we're looking at right now where office occupancy in many places in the United States is at 75%. Where only 75% of the buildings are rented out. That is horrible, and that is likely that is probably the one thing that is likely to trigger some degree of unexpected crisis here in the U.S. Meaning that the two things that I was talking about, something that unexpected and unpredictable happening on the geopolitical side, or something unexpected happening on the domestic economic side, that is the one big fear that I have, is that the office occupancy sort of decline here really starts to hit on the ability of people who borrowed money to create office buildings to pay back their loans, which affects bank liquidity, which affects everything else. That is what I'm actually worried about right now. That's probably my biggest worry, and that's not everyone else's biggest worry. But just getting an insider's view of what that looks like over the last 3 or 4 conversations that I've had with people in commercial real estate, that's my biggest fear at this point. Now, all they think about is buying, rehabbing, and renting out these places. They're not really concerned about the back end finances of those deals and how that affects banks. And they don't think that way, but I do. So, let's talk about Tesla here. Okay, is a Tesla bot a good idea? Will it take jobs away as well as robotaxi if that takes off? Every day I become marginally less convinced that robotaxi is actually going to happen. There have been a lot of people fired recently across the board when it comes to the robotaxi business or autonomous driving business, which is an indicator to me that there's been a failure of direction, a failure of direction in a lot of these companies. There was one of them that I was reading about, a couple people in Class 8 trucking who were designing autonomous driving software for like big rig trucks. Some of that's gone away. They just fired someone today for improper contacts with at a Chinese company as well. This was another company developing autonomous driving. Looked like I think it wasn't Dana International, but it was PACCAR and a couple of other people's let go, some pretty senior engineers. Now they got snapped up by other people in the industry, of course, or they will get snapped up by other people in the industry. But to me, that's an indication that the direction those engineers and executives took the company was not the one that they wanted to go in, which means some really expensive rewrites, some rethinking of how that code is written. And there's not a guarantee that this problem this issue gets cracked. And I talked to a lot of really skeptical computer scientists about this as well. When I asked them, and this is perhaps an overly broad question, and perhaps a question that can't be that can't really be answered. I'm asking them questions like, well, how long do you think before we have autonomous robotaxis? Or is level 5, autonomous, technology really possible with today's, hardware or software or understanding of neural networks? And the answer is always, it's much further off than you think it is, Jason. And it's much further off than these people that are working in the industry are making you think. Now, these people are involved in academia, right? They're not involved in business. Academics are famous for not getting things done quickly. And this is one of the reasons. Well, there's a couple of different reasons I would never work in academia. Number one, I get in trouble for saying too much. But number two, kind of forgot where I was going. Hold on a second. Yes. Number two, I couldn't stand the pace at which things worked in academia. There was never a sense of urgency. So that may be affecting their estimations as well. But the more I look at this, the more I realize that there's a lot less certainty in the idea of autonomous taxis than people think. If Tesla were to have a profitable business in autonomous taxis in the next 5 years, I would be absolutely shocked. I would be stunned, especially considering when you look at just the design delays and supply chain delays that they've had right now with the Cybertruck. This is a product that is not guaranteed to be a success. Even Elon Musk himself has said it's not guaranteed to be a success. And then we come along with the Tesla bot idea as well. Tesla bot is, I think, maybe a great idea, but I actually don't think it's going to be a humanoid bot that ends up becoming most successful. People are creeped out by things that look human but aren't. I think it's going to be a non-humanoid bot that ends up being the one that takes the commercial world by storm. Like if you could have, a butler that looked like something like the robot from that 1950 show Lost in Space or something like that, that's probably going to work out better than a bot that mimics humans. This is one of the phenomenons I was talking about my son with the other day. We were talking about like monster legends and things like that. And I asked my son, I was like, so why do you think it is that humans on the planet across cultures have all developed a fear of something that looks human but is not? My son thought about it for a while and he was like, well, because something that looked like humans was probably eating us in the past. He's very blunt when it comes to things like that. And I agree with this. I think there was some sort of competition between hominids back in the day that resulted in a lot of getting consumed, and probably worked both ways. Like we probably ate Neanderthals, they probably ate us or whatever, but it gave us a fear of something that looks very human that is not. But then my son went deeper than that and he said, hey, Dad, so why is it that we're afraid of things that look human that are tall and slender, right? And that's the thing that everyone's afraid of. And I started thinking about that. Is that really true? And then I realized it kind of was. So we have an instinctual fear of something that is tall and slender and humanoid, but not human. And I think that that instinctual fear is a biological fact that was ingrained in us for reasons that we don't remember anymore or aren't recorded. But I think that that's literally the imprint of that fear is one of the reasons why a humanoid robot is probably not going to take off for a very, very long time. People have this instinctual discomfort with something that looks too human. So Shula just says, I'm jealous. My goal is to retire in Costa Rica. A lot of what I do in my professional world is retirement planning. And you'd be surprised how much Costa Rica comes up. And when we run the math on Costa Rica, we find that it's actually pretty expensive to retire there, even in comparison to the United States. And so Ecuador right now, or the countries that some of my clients are looking at Colombia, Ecuador, Colombia, Thailand, Philippines. A lot of that has to do with lower cost of living. Vietnam, lower cost of living. Where else? Surprisingly, the countryside in Japan, like cities in Japan are extremely expensive. Countryside, not so expensive. I don't think they realize, though, at least the one person I talked to, that nobody speaks English there, and he doesn't speak a word of Japanese, not one single word. But he went on vacation there and saw how cheap it was to live in the countryside there. But Costa Rica, I was surprised when I visited, and even when I went to like non-tourist areas, food expenses are relatively high there. Not necessarily street food, but like grocery store food is. So is it possible that we need new technology built into the roads to make robo-taxis work? I think robo-taxis are probably going to work by talking to each other. And it's probably not going to reach a point of the singularity, for lack of a better term, until almost every car on the road is working on autonomous driving. Meaning that when a Tesla can communicate with a Ford, and a Ford can communicate with a Chevy, and a Chevy can communicate with a Neo or Xpeng. See where I went there? I think that's the point where we see possibly like autonomous driving. We may never really see true artificial intelligence, but we'll see road management with all of the cars speaking to each other. And I think that's probably what's going to happen. All right, guys, my voice for some reason is giving out a little bit today, and my throat's actually starting to hurt here. So unless you guys have any additional questions, I'm going to go ahead and hop off today. I do want to go see my daughter's wrestling practice later on today. And she's stunningly good at wrestling. Showed no interest in it until the last couple of months, but stunningly good at it. I want to go watch her practice today. Anyway, any more questions? If not, I am going to go ahead and sign off. I did want to thank you guys for coming back, and thank you for being patient, because last Thursday I had someone in my house, which, by the way, that turned out to be a disaster and the work never got done. But it is rescheduled and now it's 6 weeks. But anyway, I didn't want to do a live stream with a contractor in the house, honestly, because I'm just too embarrassed by the fact that I do that. So, all right. Anyway, thank you. Nice to see you again, George and Bram. I'm sorry I didn't get your comment. I just saw it right now. But yeah, as a pre-boomer, I'm holding off on long-term care for as long as possible. Yeah. Just don't use the plan that all of my clients say they're going to use, which is, they're going to put weights on their shoes and take a long walk into the ocean. Exactly 0 of them have done that. And a lot of them end up spending a lot of money on long-term care. But yeah, I will see you guys on Thursday for sure. Thank you very much for attending. I'll talk to you later.